Hey folks, Dan Frio here of the Mortgage Minute. So what we're going to talk about right now is what I spoke about this morning. So if you watch this morning's video, thank you so much. I'm actually in West Virginia. I had to come here for family purposes. But I wanted to retrack back to what we were talking about this morning. So this morning we had the CPI number coming out, and it's consumer price index. It's how much inflation there is at the consumer levels. And I knew there was going to be higher than 9%. Not a lot of people predicted that. They thought it was going to come in about 8.8%. And I said, no, there's no way it's going to come in. It's going to come in higher than 9%. Why? The one piece of this element that most people are missing is the energy factor, the oil. Oil spiked in June, so it's not going to show up, or didn't show up in the previous readings, but we have CPI now that came up, and I predicted here's what was going to happen today. Here was my game plan. Is the CPI number is going to come out, and it was going to come out above 9%. It actually came in at 9.1%. Then what I called is I said, well, here's what's going to happen. I gave you the roadmap. I gave you the game plan. I said the stock market's going to sell off big, and mortgage rates are going to spike initially. Okay, so then what the prediction was from there is it's going to give it most of the trading day to settle down, because people have to really dig into these numbers to figure out what the heck's going on. So the market opened up right after this report came out. The stock market opened up, well, I'll say down 500 points. Okay, so I called that one because of the CPI number. The next piece of the puzzle, I said mortgage rates are going to spike. Well, the MBS market, if you guys watch me on a daily basis, the MBS market was down 51 points. 51. That's probably 0.25% or 0.3% increase in mortgage rates instantaneously when the CPI number came out. So that's exactly what happened. Okay, let me recap it. This morning, I said CPI number is going to come in above 9. Stock market's going to drop dramatically, and mortgage rates are going to spike. That game plan rolled out perfectly. Then I said, wait, give it most of the day and let the analysts do what they're doing. So again, how did we end up the day? I said, just hold off. By the end of the day, we'll be back to neutral, probably, once they dig into the numbers. I'm going to go over the numbers with you in a second. What happened? It laid out like a roadmap, folks. So I can't do any better than that. I actually was impressed with myself because I nailed it to the T. So what's going to happen now? So that's the biggest question. So here's my roadmap of today, but let's first talk about the numbers. Let's go into the CPI numbers. Let's go into the inflation numbers to figure out what actually is pushing or causing all of this. Okay, here's the top 5, I think it's top 4 pieces of the CPI number on the hottest pieces of the market that has the most inflation. And I've been saying all along that it's oil. Okay, so based on this information, let's break down what's causing this CPI number to jump. Number one, gasoline. Gasoline prices are up 58.9%. Okay, that's part of this CPI number. Okay, I'll say 59% gas prices. I don't know about you guys, but last week or the last couple weeks, I saw gas prices at $6 a gallon in Chicago. Now we're at $5. I never thought I'd be giddy about seeing $5 gas prices, but that's where we're at. So we're seeing that drop. Okay, and we're seeing oil prices in the range of about $100 right now. We keep teetering below 100, which is great. We need that oil prices to get down to about 60 to 65, maybe to 60 to $70 a barrel. That'll curtail a ton of this inflation. But let's get back to it. Another piece of this puzzle is airfares. Airfares are up 34.1%. Why is that? Well, because they needed to raise their rates because I think they were too low. I was going to Florida every month because I was getting down there for $80. But the next, I hate vertical prices, so thanks a lot. So we're starting to see, even in the airlines, a big piece of their inflation, or their piece of their puzzle was fuel prices. Okay, so the next piece of this puzzle is household energy. Household energy. So you probably use natural gas if you do that, or propane or whatever. Again, what I said, natural gas is now in a bear market. Okay, those prices have plummeted. So we see oil prices way off the highs. They were about $130 to $140 a barrel in June. Now they're about $100. Major pullback. We see natural gas on a bear market right now. So those two pieces of the puzzle are starting to really retract. The next piece of this puzzle is transportation. Wheelhouse that around. Well, it's gas. Keep rolling that around. It's oil. So the top 4 pieces of this puzzle is energy. We know there's an energy problem. What the government's doing to fix it, I don't know. But once that starts to subside, and we're seeing it right now, you're going to see the inflation numbers pulling back. Like I said, you guys are going to be naysayers. Guys, I couldn't have wrote this roadmap any better for you at this point. So that's where we're at there. So now let's start talking about what the Federal Reserve is going to do. Now the playbook there is this. The Federal Reserve has a meeting coming up this month on the 26th and 27th. What they're going to do, and it's already baked in, they've already told us this, is they're going to raise the federal funds rate by 75 basis points. Before I'm done, let me explain what the federal funds rate is a little bit past this conversation that I'm having. So the Federal Reserve is going to meet later this month. Okay, the inflation number is hot, but they're not dumb. Hopefully they're not dumb. They're going to look at these numbers saying, guys, most of this stuff, we're seeing lumber prices come down, car prices coming down, used car prices dramatically coming down, energy prices coming down. That's the biggest piece of this puzzle that we can really fix. You're not going to be able to fix wage inflation. You can't. Housing expenses, they count in the CPI number rents, because how much rents are going. That's going to start stagnating, maybe. And there's a wheelhouse around that as well. So, okay, let me get to this. Let me explain to you first what the Federal Reserve does. So the Federal Reserve, a lot of people think they control interest rates basically across the board. They don't. The only thing they control is what's called the federal funds rate. Okay, what is the federal funds rate? It's basically at the end of the day, let's say I'm Citibank and I have to have $1 billion in reserves every night to be deemed solvent by the FDIC. Okay, but I'm short, $1 million. So I got to get that $1 million before the day closes. Otherwise, my bank is insolvent. So I go out there in this open market piece, and I get money, and I get money borrowed to me overnight. Okay, that's the federal funds rate. So I go out there, and it might be Wells Fargo helps me out, and they give me $1 million because I need $1 million. They charge me an interest rate. That interest rate is the federal funds rate. Okay, that's it. That's the only thing that the federal funds rate is. Okay, so now what that has is a trickle effect on the whole economy. What it does is now the banks have higher cost of funds. Okay, so they're going to push that along to consumers this way. You go to the banks to get a personal loan. You go to the bank to get a mortgage, but the mortgage isn't tied up in this. It's actually tied up in what? If you guys watch me every day, it's tied up in a bond that trades on Wall Street. That bond is called a mortgage-backed security. So it's really not dealt with at the bank level, but your credit cards, your car loans, your personal loans. If you get a boat, it's a bank loan. All these shorter term loans are factored in by the banks, who then just increase their rates because their federal funds rate went up. So all those rates are going to go up. Okay, so that's what causes all this. Now let me explain to you why what happened in the markets happened like it did. So the first thing I saw was, I knew the CPI number was going to come out. And if you follow the oil markets and all the other stuff like I do, I knew this was coming on. But I said, okay, it's going to be shock and awe at the beginning, because people are going to see this number and saying, oh my God, everything is so much more expensive. But you have to really dissect the numbers. You can't just read the headlines and say, okay, well, inflation's crazy. I know, because I'm paying this much at the pump and the cost of bread is this. But if you really dig into these numbers, you saw that the oil was the biggest piece of this puzzle. Okay. Well, in June, when we got the CPI number, it actually gave us May's numbers. Okay. So there's always 1 month kind of lagging. In May, we had high prices, but we didn't have the $140 barrels of oil like we did in June. So when we got the CPI number in June, those numbers weren't baked in. But I knew coming into July, the June numbers were going to show a very high number, and it was all going to be focused around energy. That's what happened. So then when all the analysts see the number come out this morning, they're like, oh, geez, everything's going to go bad. And so they start selling off stocks. But then once they start looking through it, like I did, you can probably see it on my iPad. I actually have read the Federal Reserve notes today. The biggest piece of this puzzle is what we just went over. It's actually gasoline, airfares, household energy, and transportation, which all revolves around oil and energy. Okay, so when that starts to subside, now we're not going to have inflation going back to 2 like that, but it's a way to get back there. It's a way to start decreasing the inflation numbers. So what my game plan is, or my roadmap is for the next couple months is this. Here's what the Federal Reserve is going to do. So they're going to meet on July 27th, 26th, and 27th. They're going to most likely 99.9% chance they're going to raise the federal funds rate by 0.75%. And then they're going to give us their guidance on what they're going to do. That's going to be a huge play this month. So I'll do that event live and kind of explain to you as they're talking about things. But what we want to focus in there is what the Federal Reserve tells us they're going to do in the preceding months. So hopefully they come in and at least give us some context, not just saying, well, we'll just do what's needed. They'll come in and give us at least some guidance, and that's what I'm working on right now. The federal funds rate should get up to about 3.25. That's what all the analysts and myself and the dot plot for the Federal Reserve is telling us, and I won't go through all that right now. But so we have about a 1.5% rate. We need the federal funds rate to go up about 1.5% more by the end of the year. So if they do another 75 basis point hit this time, they're going to be kind of halfway there. So going forward, I'm expecting in the September, they're meeting again in September 20th and 21st. I'm expecting them to come out with probably about a 50 basis point move up in the federal funds rate, meaning 0.5%. But let's think of it this way. Let's say that the July CPI number comes out and it's 6 or 7 because we're seeing fuel drop dramatically. So what's the Federal Reserve going to do at that point? They'll probably say, well, we got to do something. So they might come back and say, we're only going to do 0.5% this time. That's what my prediction is, because they have to do something. They have to appease the markets right now, but they can't really do a shock and awe because the markets can't take it right now. There's so much bad news out there. If you look at everything, you got China with the COVID thing again. You got China maybe taking over Taiwan. You have the Russian-Ukraine situation. You have oil prices skyrocketing. You have fertilizer issues that I talked about this morning. We're going to have a food shortage, believe it or not. These are things, I'm not a doomsayer. I'm just telling you this because I'm seeing it all around me. Okay, so that's what's going on there. So the Federal Reserve is going to come in, raise rates 0.75%. They're probably going to tell us they're going to do whatever it takes next meeting to do what they need to do, and they'll probably come out and say we'll do probably at least 50 basis points. So from there, I don't care what they say from there because it's going to be irrelevant because we're going to start seeing the inflation numbers peak and starting to drop back down. So also, the yield curve. If you guys ever watched anything about the yield curve, or if you see somebody saying, hey, there's going to be a recession because of the yield curve, let me explain what that is. Basically, there's a plot line or a yield curve that tells you where yields are on 3-month treasuries all the way out to the 20-year treasury or the 10-year treasury. It's inverted right now. So that in its essence doesn't really mean we're in a recession, but when you couple that with 2 negative quarters in the U.S. of negative GDP, we're in a recession. So they're not really going to tell you that in mainstream media right now. They're going to wait and wait and wait. And then the Q3 or Q4 of this year, they'll come back and say, Q2, we were in a recession. Mark my words, tag this video because it's going to happen. That's exactly what's going to happen. So now, why you're here? What effect is this going to have on real estate? Okay. So that's what we try to dissect here on a weekly basis. I invite realtors all over the country to sit with me on live and you guys to ask the questions. And I would love participation with you guys to ask the realtors these things. But tomorrow I'm going to do a video. I'm in West Virginia right now because I had to come back here for a family emergency. I'm going to do at the top of the hill where my parents live. I'm going to show you a video of where I grew up. Guys, we're not in a bubble here. We're not in a bubble. It's not going to crash. Prices are good. Homes are awesome. Cost of living's sweet. Don't even know why I don't live here, but there's no bubble here. So when you see all these things, there's a bubble, there's a bubble, there's a bubble. What happens? The one thing that everybody wheelhouses around is, 2010, we had a complete crash because, prices went up too high, too fast. There's so much more to that story. And if you watch my video every day, or at least every so often, you know what the backdrop was in 2008 through 2010. Negative subprime mortgages that had teaser rate, option arms, and all those crap loans. They're no longer in existence. So the one argument that can't be said is, the market's up, or the prices are up so high that it has to crash. No. If you said that, we would still be back in where house prices were in 1900 because, well, it went up, so it's got up that high, it's kind of come back down. It doesn't work that way. Okay, so it's supply demand. We have more millennials now in the market than we had baby boomers. You probably didn't know that. So we truly do have a shortage of homes. So you have all these naysayers out there saying, oh, I'm so tired of hearing the shortage of homes. We have a shortage of homes. Okay, it's you can go anywhere and find the information on that. So if they come back and say, nah, that's really not true, please turn the channel, because they didn't do their due diligence, because they're not educating you guys in the right format. So we're going to have, as the supply chain issue curtails itself, we have people coming back in the labor force, and I think the people are going to start doing that gradually now, and I'll explain here in a second. You're going to start seeing more houses being built. Okay, we're also seeing the existing homes starting to come on the market. Why? People just, they finally said, okay, I'm going to make a move or do whatever. And as we stay at interest rates at 5% or so, people are going to get more comfortable with that, and people will be more likely to move in those aspects. So that's basically what's going on there. We still have great demand. So still to this day, and I saw before I did this, I did a bunch of scanning through YouTubes. People are out there, hey, inventory is out the roof. So that means houses are going to plummet because there's too many houses for the demand out there. That's BS. If you talk to any realtor worth their salt, they're going to tell you this. We have a lot of supply coming back. And yes, it is more than last year. Well, obviously, it's going to be more than last year because nobody really put their house on the market last year, and I'll explain that in a second too. Well, now you have people that are finally, like, they're out of their forbearances or whatever. Now they can put their house on the market, cash out, and do whatever they want to. But you can't use the analogy of, house, there's tons and tons of new homes on the market. So if you're new to the channel, and if you're old to the channel, I apologize about this, but let me explain to you the supply-demand argument that a lot of people have. There's too much supply in the market right now because last year we were only at this, okay? Why can't you use last year's number? Well, the biggest reason is forbearances, okay? Here's what a forbearance is, and I'll try to get through this quick for those that watch me every day. Forbearance was, if you're a homeowner, you could call into your mortgage lender and say, I need the forbearance agreement. I need to postpone my mortgages. They don't even ask you why or anything. They just say, okay. And you can postpone your mortgage up to 18 months. So let's say you were in a forbearance, you called in the bank, you didn't have to do any proof for anything. All you had to do is call and say, yep, I'm affected by COVID. They're saying, okay, well, you don't have to make your payments right now. Okay, so you're not making a mortgage payment. Why in the world would you sell your house? Because why? You need somewhere to live. So if you're blessed to live with family, God bless you. But if you're not, you need a place to live. You have a wife, kids, a dog, everything else. You need a place to live. So you have a house you're living in now that you're not making a mortgage payment in. So, but if you sold it, then you'd have to do something. You have to rent or something and start making payments, housing payments. Why would you put your house on the market? Okay, so the analogy, well, last year the numbers were this. I don't care what last year's numbers are. What is it post-COVID or post-forbearance? That's the number I want to see, or pre-COVID. So the pre-COVID numbers, we're still not there yet. Okay, so almost every realtor I talk to says this. We have supply coming on the market, absolutely, and it's well needed. But we still have way less inventory than we need. Okay, so the average market, when I talked to, I think it was Courtney the other day, she said our average inventory is about 6 months of inventory. I think she said we're at like 2 or 3 weeks right now. So that's how much more inventory they need to get to the point where there's more inventory than buyers. Still, you have multiple bids on properties. So the next piece of the puzzle people are saying is, well, house prices, there's a lot of people, pulling back the prices on homes. Well, the consensus vote with every one of the realtors I spoke with in the last 2 months on live, so you can go back to these and watch them, said, here's what's happening. Everybody thinks their house is worth more than their neighbors. Okay, so my neighbor sold it for $550, and my other neighbor sold it for $560. I'm going to get $600 because mine's that much nicer. So they put in a house, even if the realtor's saying we're not going to get much bids at $600, that's way overpriced. I don't care, I'll get it. My house is nicer. Put it on the market for $600. A couple weeks go by and they're like, we're not getting any takers. Well, let's go to $590. Then they drop it to $590. Not getting any takers because all the people buying already know the houses are selling for $550. So until it gets to $550, $560, nobody's probably going to even place a bid. So that's what you're seeing. So the argument on the other side is going to say, see, you have all these price reductions. Well, price reductions on prices that were escalated anyways. So that's that piece of the puzzle. So you have to really do your due diligence and dig into this. So tomorrow I'm going to do a video. Like I said, it's going to be on the top of this mountain. It'll be pretty cool. So I hope you join us there. I'm going to show you the Ohio River. I live in West Virginia. Right at the bottom of the hill where I grew up, there's a river, the Ohio River, and right across the river there is Ohio. I'm going to show you Ohio and say, here's Ohio. There's no bubble right there. I'm going to show you the houses, and it'll be a pretty cool scene. And you can see. So when you see all these things, oh, the world's going to end. The bubble's going to crash. Well, maybe in Austin, San Diego, some other areas such as that. But it's not. You can't just lay it out all over the place and say, there it is. Every place in the whole world's going to crash. So again, to recap all this, guys, if you watched me this morning, here's what I said. I said the CPI number is going to come out. Yesterday I said this. The CPI number is going to come out in excess of 9%. So this morning I came in and I said the stock market's going to drop dramatically at the open, and then this, interest rates, mortgage rates are going to skyrocket right at the open. But hold off, wait, give analysts time to review the Federal the CPI numbers, and once they do, and they realize all this is basically not all of it, but a huge piece of this puzzle is oil and energy, they're going to say, that changes my mind a little bit. So then they're going to go back and the markets are going to recover. So recapping this, Dow Jones opened up today down 500. It closed the day, I think, down 10 maybe. The MBS market was down 54. We ended up 11. It worked out just as my roadmap predicted. So I'm not on Nostradamus. I call this one because I see this trend every time that we get some numbers out. Nobody ever listens. That's why I was excited to come back today, because I'm going to keep posting these things. And all I ask you to do is please share my videos. Do you know anybody that's looking for homes or really want to get a deep dive into real estate, and they're contemplating, well, do I want to buy now or should I just wait? What are you waiting for? Okay, we're not going to see, maybe you'll get more houses on the market. That might be one reason. Okay, I get it. There'll be more inventory to pick from. Okay, that might be able to get you a better price point. Cool. Mortgage rates should stay stagnant about, I'm going to say, and this is a big range, between 5 and 5.5. We're starting to already see that coming down now, but everything is pointing to a recession. So what happens in a recession normally? Well, the world doesn't end. What a recession is basically just a slowdown in the economy. So you're going to have companies starting to slow down. And in this case, usually you see a lot of job losses. Well, you're not going to see that dramatic of job losses right now, other than if you sugarcoat that information saying, oh, look, all these mortgage companies are laying off people. Well, yeah, because we were in an unprecedented time where mortgage rates were the lowest in history, and we had to keep up with demand. We had to hire a bunch of people. But now the demand just gets back to normal. So we don't need that much staff, unfortunately. So that's why you're seeing a lot of mortgage stuff going away. The bankruptcies, that's a lot of mismanagement, and they just can't keep up with the competition in that area. So that's what you're seeing on that side of the fence. But again, I'm not looking at a crash at all in the housing market. Now, maybe in 2023, 2024, we might see a little pullback. Don't know, but I'm not predicting that. So I'm not bearish on housing. I actually think housing is still a great investment if you're going to stay in that house for 5 years or more. So that's my talk for right now. But you guys are coming on here. Guys, the only reason why I'm doing live, and I know it's an inconvenience for you, is I don't have the ability to record where I'm at. I'm at my mother's house, staying with my mother because my mother-in-law is in the hospital, and we're back here visiting her and just, keeping up with our families. So I apologize about that. But you're asking questions. I'd love to answer any questions you got. Sorry, I got to put my cheaters on. I'm old, and I'm sorry about the backdrop and all the other stuff. I'm in my mom's basically her sunroom, and I tried to shut off everything as much as I can so I didn't have a lot of glare. So I know this isn't the greatest piece of the puzzle, but I'm just trying the best I can. So let's go through some questions. I'm looking out my window. I see about 200 homes that were put under contract last year and don't see much action finishing them. That's one area that really is, are they not finishing them because of labor? Are they not finishing them because of the supply chain issues and they don't have the materials? Because what's happening is, especially in a lot of the building side, the builders have, I won't say, they were in the catbird seat for a long time. And why I say that is because people were just getting into lotteries, seeing floor plans of something, and then putting in a lottery to just have the ability to buy a house. That's not the way to buy a house. You go, you kick the tires, you look at this, you look at that. I know they don't have tires, but you know what I mean. You want to go in and see all the pieces of the house. So on the builder side, there's a lot to take in there. So I don't want to say, what's going on there, but a lot of the naysayers are going to say, see, you've got all these subdivisions that are they're going to go bust. Well, you have a lot of money sitting on the sidelines with investors that are willing to swoop in and buy these places. So those places, I guarantee you, I won't guarantee you, but I'm pretty confident those houses will be gobbled up in the next 6 months or a year. Why? Because investors are jumping in, buying up the market. They're still buying up the market. Why? Because they finance it all through bond offerings and or cash or whatever else. And then they have the ability to do anything they want with the rents. Because if you didn't buy a house, you're at the mercy of the landlord on how much they're going to pay you in rent. So what the investors are doing, I know this. I've been talking with them. They backload the numbers and say, okay, we need to raise our rent 25% to make sure we get a 15 to 20% return on our investment. And that's what they're doing. So if you're renting right now, please post down and let me know how much your rent, if you're renewing for next year, how much it went up by chance. But what I also like to do is if you would put down where you're coming from or where you're watching from. I love seeing all over the country where we're getting people that are tuning in, but I greatly appreciate it. And Slot, I hate vertical blinds. Hold on, I don't know if you guys could see that. High mortgage rates. How high mortgage rates by next month? I'm saying the shock and awe is out. The Federal Reserve already came out and did what they're going to do. I want to see tomorrow in the next couple, when the Federal Reserve minutes come out, the Federal Chairman Powell will be out. I think he came out today and spoke. But I want to really dig into those details to see what their forward guidance was to give you an idea there. But I'm still saying the rates should be about 5.5%. I don't see any huge spike, and there's really no reason for them to come down as well. So I'm thinking we should be pretty stagnant for a while. And I got to show you guys this one. I hate vertical blinds. Dude, I do too. This is my mom's side door, and those are vertical blinds. They used to have a really nice golf course back here about 20 years ago, but a developer bought it and put in a bunch of homes, and my parents hate it. Inventory is low in Las Vegas. Okay, so we have the first thing is we have somebody here, Slot Kid, said he's in Las Vegas, and I see 200 homes that were put under contract last year, and I don't see much action finishing them. And then on the other side of the spectrum, we see inventory is low in Las Vegas. So it's either there's 200 houses vacant or there's no supply. Kind of odd. So now you get where I'm coming from when I start hearing people say this, and then it's not all over the world. In your area, you might be in one section of Las Vegas, and they're in the other end of Las Vegas, and it's a completely different world. I don't know. Okay, Dan, I really like your videos. I see that new construction houses in Central Florida are cutting prices drastically. Not all areas, however, most of them new construction in non-existing homes. Thanks for the input. So what you could probably see in here is cutting prices drastically. Their profit margins are pretty substantial. And the reason why I know that, I had a realtor on last week, Courtney, and she deals with a lot of construction out in Denver. And she said right now she has some of her builders offering up to $30,000 in free upgrades. To be able to offer $30,000 in free upgrades means their profit margins have to be pretty darn high. Okay, think about it. So they have room to move. So don't think that they're just plummeting rates or plummeting prices. Also, you have a lot of the pieces of that component of buying a house. Lumber's down huge. That's a huge piece of the building products. So if you have lumber dropping 50%, okay, you can actually afford to drop your prices on your homes that much more to start selling them. So I hope you get my point in that area. Can you share some of your thoughts? Why? Here, let's see. By regular gas in Central Florida's, by the way. Noel, I don't know, but I know in Illinois, our prices we just hit, on some stations are still at $5.30 and some stations are $4.999. I'm here in West Virginia right now. It's $4.25. What has to do with a lot of this stuff is, like in Illinois, we have huge gas taxes. Some areas don't. So it's how much. A lot of times the profit margins at the refineries, they're huge anyways, but they put out the gasoline to the stations, and then the gas station people don't make that much money, believe it or not. I used to know an owner of one. He said we make about a penny a gallon, which it adds up, but that's not a huge profit margin. But a lot of the taxes, like in Illinois, they added an additional 25 cents per gallon last year. You should have saw the lines the night before that took place. So a lot of it is your state, your county and your city taxes that get added to that, the price of gas. So that's one of the reasons why you see gas prices fluctuating all over the place. But that was a great question. Thank you so much. Dan, hope your mother-in-law is doing, she's actually doing much, 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 much better. Thank you so much for asking. We got a call on, when was it? Monday night. Then my mother-in-law got rushed to the hospital with cardiac arrest. So we rushed out. I had to do some things Tuesday morning at the office, and then we jumped in the car and drove all the way to West Virginia from Chicago. So that's where I'm at right now. I'm at my mother's house. She's fine. But my mother-in-law, who just lives about 6-7 miles away, she's in the hospital, and she didn't have cardiac arrest, thank goodness. She just kind of went out. She was basically dead for about a minute or two, and they brought her back, and they're trying to figure out what the heck is wrong. So thank you, everybody, for watching. And that, again, that's why I'm doing these videos like this. I'm sorry about the quality, but I'm hopefully the quality of the information is worth watching. So thank you so much for the kind words. Let's see. Who did I just answer? Greater good, greater good, greater good. Thank you, greater good. You were on here earlier too, so thank you so much. Oh, shoot, I just scanned. If I miss your question, I apologize. I'm not picking on you and not looking at anything. Noel, Central Florida, cool dude. We're about. I would love to know, some areas. I have a place in Florida. It's Cocoa Beach. So if you're in Central Florida, you might be Tampa, Orlando, something like that. I have a place in the Cocoa Beach. I go down there. I used to go down every month, but I haven't been down there in a couple months. We just refinished a lot of it, and I love it down there, but not this time of year. Next one is Volusia County. Where's Volusia County? Volusia County. If you can answer that one, I'd greatly appreciate it. So here, I purchased a home with a mortgage rate of 6%, 3 years from now. Wait, scenario. I purchased a house with a mortgage interest rate of 6%. 3 years from now, interest rates drop to 4%, and I want to refinance, but my house market correction lowers about 15%. You'd have to analyze it that way, because that scenario is, I get it. You'd have to analyze it, because here's what happened last time. And here, I'm not trying to duck your question. You could still refinance, but we'd have to really decide. You'd probably need maybe PMI at that time. You don't now. I don't know what loan product you have. For example, if you have an FHA, USDA, or a VA loan, you can refinance it real simple. You don't even need an appraisal. Okay. They have special streamlined refinance programs for those. So don't worry about the house value there. The next piece of the puzzle is if you have a conventional loan. Well, I don't know how much you put down. So if you put down, 3% and the market corrects down 15%, well, in a year or two, you won't be able to do anything because you'll probably be at where you owe what the house is worth. But over 3, 4, 5, 6 years, I would greatly doubt that you'd be underwater from where you bought it. So then that's when you would analyze everything and say, okay, I can refinance? Even if you went from 6% to 4%, even if you had PMI at the 4% that would go away probably in a couple of years, you're probably better off doing it that way. But it's a hard scenario because I don't know, if things retract 15%, how much did you put down, what kind of loan type you have, and all this stuff. The mortgage business is complex. And that's why I hate when people just go online, find the cheapest rate possible and go with it. Because did you get the right program? Did they give you the right guidance? Are they going to follow up with you? Are they going to be there? I've been done this for 33 years. I had a client call me the other day. I did his first purchase on his house 20 years ago. And he's moving from Illinois down to Atlanta, and he needed help, and we're his mortgage person again. So I have no thoughts of getting out of this business until the good Lord tells me I got to get out of this business. So, but thanks for your question. I'm not trying to be vague. I'd love answering every question as specifically as I can, but that's a tough one. Continue. Now the home may be underwater. Do I have to come up with a difference? No, don't refinance. Yeah, well, if you want to refinance, yeah, but at that point, I probably wouldn't refinance. Or maybe at that time, again, if you have a VA, USDA, or FHA, you don't have to worry about it. But if you're in a conventional loan, that's an area you might be stuck. You might be stuck. So, but maybe wait another year and the housing market corrects, and then you can refinance at that time. So, but that was a good scenario. Appreciate it. Let's see. Every time I drop down, I don't have a mediator today, so my apologies to do this. Yes, Southern Las Vegas, Mountain's Edge. Cool. Okay, thank you. Sorry to hear that. No worries, guys. If I apply for a loan and the rates go down later, will I be stuck in with the higher rates? Okay, so here's the two biggest products we have, and I'm sorry, I'm starting to even get darker because it's getting darker here in West Virginia. So here's what we have. If you're building a house, I would highly suggest you look around and lock in a rate now with basically anything you can get. Okay, we have rate locks up to 6 months that don't cost you anything. I love doing mortgages where it doesn't cost you anything. So a lot of times when I quote people, I don't quote any rates, any fees or anything, and then they'll come back and say, "Hey, this place is beating you. You're at 5.5, they're at 5.25." I'm like, "Okay, well let me see how they're doing it." Then I get it back, and you're paying 10,000 in fees, and with mine it was nothing. I'm like, well, hell, if you want to pay 10,000 in fees, I can get you 499 if you want. So I always like doing it with no cost. Why? Because the markets are so volatile. I don't want to spend $10,000, $15,000 today. Then if I see rates next year at 3.5 and I refinance, the 10 grand I just spent was kind of just blown. So I'm never a proponent of really buying down rates and spending a lot of money when it comes to getting a mortgage. But what we do right now is we lock you in just so it's an insurance policy. We don't want the rates to spike and then you can't afford the property. So we lock you in at a rate. And then what happens is if rates go up, who cares? You're locked in. If rates come down right where you're asking, we can do one of two things. One, we can negotiate with that current lender we have you locked in with to give us market rates. If they won't do that, because they usually have float down options, and it depends on how much those costs would be. The other one would be, since I'm a broker, I already have your package. I have everything about you. I have the loan approved and everything else. What I could do, if we're within 30 days of your closing, or just right around the 30-day range, I'll move you to another lender at market rates. So you can get the lowest rate right at that time. Because I feel I have a fiduciary responsibility to you to get you the best rate in the entire market. And that's what we pride ourselves on. So we do have rate options on the extended locks to lock you up to a year. But they usually have to pay a point to do that. And I'm not a proponent of that. Okay, I'm just not. I'll do it for you if you want me to, but I'm not. If you're on the other side of the spectrum where you're looking to buy a house now and you just haven't found it, but you see rates every day going like this and it really gets you unnerved, we can do what's called a lock-in shop. Okay, what you can do is give us your application today. It'll take us, honestly, we can get you pre-approved within an hour and get you locked in. Okay, what that does is now you know what you're pre-approved for. Now you know that you're locked in. You got that rate no matter what. Okay, we just have to close you within 90 days, but we can get extensions on that. So those are the two biggest programs we have for people that are out there, because rates are every day just go like this. Like if the MBS market would have closed down 58 points a day, like we opened, rates would have went up 0.25%. So if you're getting a $600,000 mortgage, 0.25% is going to add up very fast. So that's why we offer those programs. So, but thanks for the question. I was thinking about move-in ready new construction. Perfect. I forget your question. I was applying great. Yeah, move-in ready. Honestly, on my side of the fence, I had somebody, I don't know if it was just recently or earlier, somebody asked me about 2 years. Sorry, I got a lot of stuff going on in my mind right now. Somebody asked me, I'm building a house and it won't be ready for 2 years. That scares the crap out of me, because what's going to happen in 2 years? What's happened in the last 6 months? Okay, we saw rates double. We saw Russia invade Ukraine. Gas prices hit the highest level ever in history. Is it going to get worse? I don't think so. Can it get worse? But yeah, I'm a proponent of I want to get now, or maybe a month or two out from now. Going 6 months to a year, 2 years out, I wouldn't personally do it. But that's, if you're asking my opinion, I would do a new construction. There's probably going to be a lot of new constructions out there that people just couldn't afford anymore, and they backed out their contracts. And I'm going to go over a video. I'm going to try tomorrow. I'm really tight on what I can and can't do here with my technology, but there's a lot of people pulling out of the markets when they're building homes, and I want to talk about how the exit strategies are on those. How you can't, to make sure you don't get burnt or lose your money if you're getting in new construction or under contract with a home. So that's that piece of the puzzle. And your predictions on rates this time next year, educated guess. I don't know. I hate to say that. Here's my playbook, and I'll leave it at this. The Fed is in a really bad spot, but I think the markets are doing a lot of the Fed's work. Inflation is out of whack, okay? But if you really dissect the numbers, and this is what my whole point was, today I came back and said, okay, the CPI number is going to be in excess of 9, and the stock market's going to crash right out of the gate. Initial reaction is going to be knee-jerk. That's going to crash, and mortgage rates are going to spike. So CPI number came in. It came in at 9.1. Stock market was down 500. The MBS market was down 54. 54. That means mortgage rates went up that fast, 0.25%. We held off. I told my whole staff, sit down, hold off, guys. I'm analyzing the numbers and everything's telling me all this is energy. We're having energy really take a pullback. So we held off. Mortgage rates actually got better by the end of the day. Not from where we were, but better from the day before. So we picked up that 0.25% that we lost this morning and actually got better rates from there. So that's what happened. The stock market recovered from down 500 to down 10. It was up 20 at one point. So everything recovered exactly as I said. Now, again, the only thing I can tell you is what the Federal Reserve most likely is going to do. They're going to increase the federal funds rate 0.75% on the 26th. Their meeting's the 26th and 27th of this month. They're going to come out on the 27th saying they're going to raise the federal funds rate 0.75%. Then the whole thing is going to revolve around what they tell us from there. What's their guidance? And I hope they give us some good guidance. But if they don't, here's my thoughts. We're seeing oil prices coming down. We're seeing lumber prices coming down. We're seeing a lot of prices starting to subside. I think this is the peak of inflation. If we can get rid of the Russia-Ukraine war, which we can't, we're not in it. Well, I was hoping we were not going to be in it, but I won't get political. If once that settles, give it 6 months to a year, we'll be okay. Okay, we'll be okay. So that's basically what I want to say. But recession's around the corner. We're in it now. So normally in a normal recession, rates will come down 1 to 1.5%. But we're in normal times. We went from the lowest rates ever in history. We actually doubled the rate in the last 6 months. So can it come down 1 and 1.5? It could. I could foresee maybe 4 to 4.5 this time next, Q4, Q1 of this year because of the recession. But there's so many things up in the air right now that we don't have any control over. So thank you for that question. Let's see. We owe around $60K on our current house at 3.25. We have about $5K extra a month. Should we put it in a savings for a down payment on a second home or pay this one off instead? You're asking my question, so I'm going to get flack down below because even Dave Ramsey doesn't like my answer. Here's my thought. I have a mortgage on my house. It's a pretty substantial mortgage. Why? I can pay it off. My fixed rate is 2.625. Normally, in a normal market in investments, I can far exceed my 2.625. So if I get 5, 6, 7, 8% yield on my money every year, okay, so look at it this way. I borrowed that money at 2.625, and I'm getting a rate of return of X. So other than this terrible stock market and investment market we're in right now, I think we've bottomed there almost. I would be a proponent of sitting on the sidelines. And then once I see a bottom in the stock market, starting putting my money in there, because somebody lent you money at 3.25% for 30 years. That is a long time. Look at your credit card rate. Your credit card rates, if you want to borrow 14 to 20%, the norm, you're at 3.25. It's almost free money. Look at inflation. Inflation's at 8 or 9 right now. So you have a loan at 3. So you're beating the market. Okay, that's the best way I could put it. Me personally, I wouldn't prepay that. I would start trickling monies into the market gradually. Take the money that you have and maybe divide it by 24, and every other week put some money into the market to work for you, so you can kind of catch the bottom. You won't catch the bottom, but you can get in now and then start dollar cost averaging all the way up. That's what I would do. Now, what David Ramsey would do is say, pay off your mortgage because you want to be debt free, whatever. So that's his prerogative. And Todd, I think you were the last one, buddy. So I just came on here to post a video to tell you guys I predicted the CPI number. I predicted what would happen in the stock market. I predicted exactly what the layout for the day would be with mortgage rates. And I'm trying to give you forward guidance on what the Federal Reserve is going to do. So that's it for today. I'm going to go back and sit down and talk with my mom and let her ramble for a couple hours about stuff. Love her to death, but she's getting a little dementia. So I'm trying to get back here more and more and visit her because our family members are getting older. So guys, I greatly appreciate it. We got another one. I'll stay on here all night. Really, I don't have anything to do. I greatly appreciate you guys coming on here, and I'll answer any questions you guys have as long as you have them. What's your take on an ARM starting at 3% and based on 180 days SOFR in the current rising interest rate? It depends on how long that ARM is, Great Good. If I were to get an ARM, I would not get anything less than a 7-year ARM. 5-year would be teetering on it. 7-year would be I would get a quote on a 7-year ARM and a 10-year ARM and mix the difference. I personally would take a 7-year ARM if the spread was different. So if you're getting offered 3% on an ARM, I would like to see what time duration that is. Is it a 3-year ARM, a 5-year ARM, a 7-year ARM, or a 10-year ARM? If it's a 3-year ARM, I wouldn't do it. I don't want to put myself into, well, you might want to do it. 3% is crazy. That's crazy low. But I'd like to see what it is. But if you're getting that quote for whatever time duration, see how much a 5 or 7-year ARM would be, and then analyze that versus the 30-year fixed, and then see where things go. Hopefully you're reaching out to us. I am a mortgage advisor. This is what I do for a living. I'm now federally chartered, meaning anywhere in the whole country where you are, I can help you, as long as you're in the U.S. or Puerto Rico. So please reach out to us. Give us a call. All our information is, check us out on YouTube or just Google me, Dan Frio, or The Rate Update. And you're going to find all the information about me, how you can get a hold of me and my team. You can go to our website, therateupdate.com, and there's a ton of stuff there for you as well. But I'd love to answer any questions that you have. But go to our website. We'd love to give you a quote. If you already have a quote, send it in to me. My email address is dan@therateupdate.com. Send me the loan quote that you have, great or good. I'd love to analyze it, get back with you and say, here's what you might want to look for, or here's what I can do. Let's compare the two and go from there. Thank you so much thanks for joining me again today, and thanks for the questions. Watching from Austin, Texas. Thanks for the update. You bet, Sam. I greatly appreciate you guys being here. This is so cool. I got people from the East Coast all the way out to California, down to Texas, up to Colorado. So the channel's taken off. Thanks to you guys. I am doing a lot of YouTube training. I actually just hired Mr. Beast's training staff to help me take this to the next level. So if you start seeing some different things on my videos coming up in about a week or two, that's why. So I'm starting to get professional help because I got the channel as big as I can get, and I don't know how to get any bigger than that. But thanks to you guys' support, you're making this all a success. So God bless, guys. That's it for today. I'll come back tomorrow. I'm going to try to do a view from where I grew up, and I'm going to show you a huge mountain and the Ohio River underneath me tomorrow, and I'll give you the morning update at that time to give you my roadmap to what's going to happen most likely tomorrow and the rest of this week. So God bless, guys. Thanks for watching. Please don't forget to give us a thumbs up. It helps the algorithms and helps the channel grow as well. And subscribe down below if you're not a subscriber, because I'd love to have you. So God bless, guys. Thank you so much for watching, and I will see you tomorrow morning.